I'm being facetious. It's just me doing my typical stuff. One shot, one kill. I told you the turtle soup, how it forms. Told you what to look for this week with the commentary on the daily chart. And some of you were surprised, like, how did that happen? Where did you get that information from? All right, so we are inside this SIBI here. And let's define it real quick. Here's your sell side. And some of you are going to be like, oh, well, you know, it's going to hit one of those levels, right? And the important factor is seeing which one they leave going into the 9:30 opening bell. And or do they leave it in place after the initial run for liquidity? And we will do that. Now we've had a nice drop this week, so it's reasonable for it to see a return back into some intermediate term buy side, especially with the non-farm payroll. Okay. So what I teach my students to do is frame out 15-minute highs and lows that are key. Relative equal highs, buy side. This one here, we do have, this, but I don't like that so much because we already hit this lower low. And we've already met the objective I had for this week, which was that August 13th daily fair value gap low. And you can go back and listen to my commentary, look at what I was explaining on Caleb's channel and the things I was mentioning during the live streams on this channel. We were looking for lower prices, and I wanted to see it get down into that 18,765.25 level. For the folks that said, you got two screens recording, just turn the trade on and go. You do it. You get in at the high. You get in at the high and you hold for the low. Do it on an execution. I don't care if it's a demo. Do it. Bet you can. Salty boys. All right, so here we got it. This is non-farm payroll. You want to trade that? You want to trade that? Woo! That's right, baby. Right to the buy side. I didn't like this one. This one's the one I liked. Now, if you think that you're going to trade these types of moves, if you think that's going to happen, and you're going to be able to get in there and they're just going to let you ride it, and you're going to get out, you're not even going to get out here. It's happening so fast, and your broker is not allowing you the execution. Every broker pulls their engagement because they know that people are going to do what? They're going to over leverage, just like everybody does with these funded accounts. They over leverage, they link 20 accounts, 30 accounts, or whatever the maximum is, and they go for broke. They try to trade as much as they can be allowed to do by the funded account company because they think it's the lottery. And they know they can't trade well, so they're just trying to get lucky on one big move. So when do they know markets move around a lot? Non-farm payroll, FOMC, CPI, PPI, and they gamble. So brokers know that. They know that. So they're going to pull the opportunity away from you. That's not a lack of liquidity for the sake of buying and selling. There's a lot of people want to buy and sell. I promise you, they all want to buy and sell. But your brokers collectively are not allowing them to do that. So that's why you have this illusion, okay, of lack of liquidity. They call it illiquidity, okay, or illiquid markets. Now, there's absolutely liquidity there, but the brokers are not going to allow themselves to see people go in and just run roughshod on them because some brokers B-book. And when they B-book, these same people that they're usually taking the money from, they might get lucky that day on a heavy-handed bet. And they're not opening themselves up. It's just like a casino. The house has the edge. They're not trying to let a card counter come in there and do what a card counter does. So what I like about the non-farm payroll is it gives me a clue, sometimes, not all the time, where it may want to trade to at 9:30. Now, how can I use the information that's been presented here? This is kind of like what I'm teaching my students over the years where we're watching non-farm payroll. I'm not telling them what to do. Okay, nobody's trying to position ahead of it. But while we did have relative equal lows here, the fact that we took this low below that one, that already indicated that this one was more likely. That's why I said I don't like this one so much. This one is reasonable. Why? Because we've already traded down to that daily fair value gap low on August 13th. So it's reasonable for it to try to go back and run up against the trailed buy stops, which would be here. This is a 15-minute time frame. It's a bellwether time frame. So having like FOMC, PPI, CPI numbers, any kind of big high-impact news driver event. I just realized I didn't check my audio. Crap. Ugh. Man, I'm just going to go with it. I'm trusting that you guys can hear me. I don't have my phone next to me either. Jeez, ICT, you're supposed to be a professional. Hold on one second. I have to make sure before I go in, because I don't want to review that trade and then realize I don't have the audio. So give me a minute, okay? Give me a second. Oh, here, Ross Cameron. Wow, the most comprehensive day trading course, according to Investopedia. Thanks, Ross. All right, so let's see. Yep, I hear myself jawboning now. Yep, 4 seconds delay. Very good, very good. All right, so anyway, back to this carnival-like atmosphere. The 15-minute time frame, okay, you really want to warm up to that time frame. That's the reason why I took Caleb's attention to. That's like his high time frame outside of the daily chart, obviously. His high time frame is not an hourly chart. It's not a 4-hour chart. It's just the 15-minute time frame. Then we can drop down to a 5-minute chart. Then you can drop down to a 1-minute chart or a sub 1-minute chart. And if we can appreciate the level of interest around stops that are above the marketplace or below the marketplace, the 15-minute does a really good job of highlighting where they're obviously going to be resting. Now, you don't need a book map. You don't need any kind of application or app. And I know there's some people out there that have created them and or are building new ones because there's a lot of interest around liquidity now because of the stuff coming out and the way I teach how to attack it. And it's framed in a way that seems mysterious, okay? And sometimes, admittedly, I probably in the very early stages created this air of mystery around how liquidity is in the marketplace and how you have to seek it. But I've never been ambiguous about where it is, and I teach how to find it and how to look for it. And then based on how that liquidity is engaged, helps you frame out a narrative, helps you determine what the market's likely to do next. Because that's really what we want to do as a trader. We want to know where is the market going next and how can you be best positioned to capitalize on that change in price if it's moving higher or lower, and or avoid being wrong more times than not. So that's kind of like what the essence or pursuit of a trader is in managing the risks along the way. So a 15-minute time frame, Caleb, is your bellwether chart for determining where the obvious, clear pools of liquidity that the algorithm will refer to for that individual daily range. Okay, so what happens if, I was going to keep this for the book, but I'll just drop it because I didn't do a live stream yesterday, so I'll give you a little bit extra today. What happens if you can frame a pool of liquidity like we did here. We outlined it real quick. Didn't take long, did it? Didn't take long. 15-minute relative equal highs here and this low here. And I mentioned the stark contrast was that this low was taken slightly lower than that one. And then going into the non-farm payroll, while these two may be viewed by someone else, they may say, well, look at this is relative equal lows. Because it's so close to that low here, if I ever see this one or something similar to this, that low being taken like that, it's already done enough to tip his hand saying, okay, at the time of that high impact news driver, FOMC, PPI, CPI, non-farm payroll like today, I'm going to elect to anticipate, let's say it that way, okay? Because I don't want you taking what I'm saying and saying, oh, he's giving me that secret nudge, nudge, wink, wink to take a long trade when it doesn't. No, no. But it does encourage a new startup or a new student when they can see these big flash moves that take place, how you can anticipate where they're likely. You're not going to be right all the time. Okay, I'm not right all the time when it comes to these big events. Okay, I have to wait because I'm not going to put money up against something that's uncertain. Just as well as I mentioned that I didn't like this one here, and this one was more favorable for a run for non-farm payroll. It could just as easily gone down, wipe this one, then one up there. Okay, so that's what I'm about to explain to you. If you can frame on your 15-minute time frame where the obvious pools of liquidity for buy side, which is here above relative equal highs, and the sell side below relative equal lows, if you can identify them both, and you should be able to do that over time by doing it every single day, this is what you should be doing also. Every section of your journal log entry, Caleb, it should have your 15-minute time frame annotating at the beginning of 9:30 where the 15-minute pools of liquidity are, because that's your bellwether on the daily range, because it's going to give you every piece of information that I'm going to help build on before we close this live stream out today when I review the trade I took yesterday that carried over in today. And no, it's not technically the 5th of September because the execution that closes the trade occurred today. So the live execution, it's not a profitable endeavor until the trade is closed, right? So the execution is September 6th, not the title of the video should be September 5th. So if we can frame the idea of buy side and sell side on a 15-minute time frame, what happens if the market at a high impact or maybe even medium impact news driver on the economic calendar, like forexfactory.com, Econoday, I wonder if, I don't know, leave a comment in the post I just made on my community tab, and or if you're a private student, you know how to get a hold of me that way. Does TradingView have a calendar? Like I don't know, but if they don't have one, they should do one. But whatever economic calendar you use, you know, if it's one of the ones I just mentioned here, I interchangeably use two. Econoday is what I've been using since the 90s, and then you have the Forex Factory one, which I got used and accustomed to using when I was teaching primarily Forex. But you want to look for the medium or high impact news events. I don't care about the yellow or the very low impact news drivers. I don't care so much about the speeches. I do care about Fed chair. I do care about bond auctions. I do care about only the U.S. stuff. Now, if I'm trading Forex, which I don't know, I no longer trade Forex, and I know all of you are upset right now because you're like, you don't talk about Forex anymore. I hate you. You want to break up with me now. The same things I'm teaching here, they work in Forex. The problem is Forex right now is being strangled. Okay, there's so many things going on in the monetary system that there isn't a lot of big placement going on. So you need huge flows coming into those pairs, those currencies to create this disparity. And because the dollar's being basically demolished, everyone's trying to determine what's the best play going forward. And that's the reason why I backpedaled away from it, because we're going to see a big, huge, like a depegging what the euro and the Swiss franc was years ago. If you've never seen what that was, do a search on YouTube for documentaries about it, because brokerage firms, large institutions, were completely wiped out instantly that day. So I know that that's coming. I don't know which currency it's going to be. It may be the dollar. It may be another currency. But everyone that's in Forex, when that happens, they're going to get crushed, immediately gone, dusted. And you're going to owe more money than you ever made in your life, okay? Because that's how it is. It's just like you're done. You'll be liquidated. You're a pink mist in the air, gone. So that's why I backpedaled back to commodities and futures trading. This is where I cut my teeth in 1992, November 5th, 1992. That's where I started. So while Forex was fun, Forex is not my thing anymore, okay? So I'm glad that there's been this big shift away from Forex. And now folks that are wanting to be traders, they take their finances a little bit more serious. They're not in there gunslinging, trying to trade with $25 accounts and try to turn them into $1,000 in a month. I mean, crazy stuff, crazy stuff, trading with fake brokers, basically. Okay, it's really what you're mostly doing with these Forex guys out there. When you're trading futures, you're trading a real market with real buying and selling interests, okay? And billions of dollars are on the line, where it's a gentleman's market, okay? And I say that because Forex, you're all going to get a different high, you're all going to get a different opening price, you're all going to get a different close, because you're dealing with brokers that are given the freedom to screw you. In futures, everyone has the same high tick, everyone has the same low tick, and everyone has the same opening price and the same closing price. It's a level playing field. That's why professionals will trade this market over Forex. That's the reason why. When you afford a broker or the clearing firm that you're using to execute your trades on, you are signing the agreement when you open up an account that they can open and close and narrow the spread at any time they want. It's at their discretion when they're going to do it. And you wonder why your take profit doesn't get hit, or your stop gets hit, but then it runs. It's going to happen more times in Forex than it will happen in futures. Now, it doesn't mean that you can't be taken out and swiped with a stop hunt in futures. But the difference is, the contrast is, you were really wrong if it happens in futures. And that's good. You want to know if you're wrong, okay? But in Forex, you have this wide degree of disparity between all brokerage, and that, to me, is a little scammy, okay? So if they are going to cannibalize their own clientele, would you choose to trade in that? Would you rather swim in the pond full of crocodiles, or get into a pond that's far enough that affords you the time to get the hell out of there? If that one single hippo is at the far end of it and you've been watching the whole time, that's what futures is. There's a hippo in this water, okay? And hippos, they kill more than crocodiles a year. But you got one shot, one chance to screw it up here in futures. In Forex, you have so many things that can go awry and go against you that are outside your control. You may not even see it happening or even understand that it's happening. So that's why I've migrated away from that, because now the climate is geopolitically primed for some major financial meltdown. And it's going to be in the currencies. The currencies are going to get crushed, and it's not going to be something that you can trade. Look at the Swissy and the Euro depegging, okay? And you'll see exactly what I'm talking about. It's 1 second it's there, and then it's immediate, the game over. Like it's game over instantaneously. Boom, it's gone. You don't have anything left. And literally brokerage firms, large institutions, were completely crushed. So I'm answering this because I'm still getting questions why I'm not talking about Forex. Because if I talk about Forex, I know that my influence is going to have people doing what? I want to trade Forex. I want to do what ICT's doing. I want to do this. I want to do that. I'm not in Forex. I don't have a penny in Forex. Zero, zilch, nada. No broker holds any money in Forex for me. None. Not one. In futures, you have reputable brokers. You have the same price. Everybody sees the same thing. It's a level playing field, and it's a professional gentleman's market. That means, yes, there's manipulation, but it's not like a wild, wild west like like Forex is, okay? And it's not likely to have the same thing happen to it, even if there is something in the currency market. There will be shock waves in futures as a result of that, but I would be better equipped mentally and psychologically to weather any adversities while trading futures versus Forex. So there's your answer for everybody that's been asking. Why you keep talking about stuff and nobody asked you? You don't know who's asking me anything, bro. So we're back up into the day opening gap. So isn't that beautiful? So we traded all the way back up to the buy side, which was favored over this because of that little tiny little tick below that. But what happens if it runs both sides ahead of 9:30? Like say for instance, it opened here at 8:30, it traded down, hit the sell side first, and then ran up, hit the buy side. If it would do that and then keep the range, whatever this, say that high right here, say stays intact, and then we march to 9:30, and it doesn't make a higher high, and it doesn't go below here. If it did both sides of, I'm sorry, I said that wrong. If it would have taken sell side first, and then went up here and took the buy side, and that range that was defined by that stays intact all the way till 9:30. What that indicates is we have a 50-50 chance that the market's going to stay inside that range and not go down and take the low out again. But what happens if it does this? It fails to take out that sell side, takes out the buy side, and then doesn't rip and keep going and crushing speed going higher. Like if it just hangs around and creates a little bit of like retracement back into the first fair value gap on Thursday, because that's what this blue line is here. I had to throw that little lipstick annotation on because I didn't want to create anything over here because the text wouldn't show up. So I had to type it in like that. So I had to make sure the recorded trade had everything on the chart. So I usually don't like to annotate that way. But if it stays the way it is right here, and we didn't take out the sell side, it means that we could flirt with trying to make an attempt to go back down here, but I would expect it to fail. And then everybody would want to chase it going lower. And then they would do something that's like this after 9:30, going into 10 o'clock, 11:30, and then closing somewhere in the middle of the high end of the daily fair value gap on August 13th. So it gives you at least something to work with initially to frame some kind of a narrative. And I know what I just explained to you for the very, very brand new students that are coming to me. It's a little advanced, but it's okay because you're seeing me outline things day after day. And when I'm talking about the higher time frame charts, where the price should reach to, what should it gravitate to, over time being exposed to that, a lot of the questions that you have right now that you think are paramount, that you can't sleep unless you figure the answers out right now, I promise you, if you just write those questions down in your study journal, just relax. The days that you have those questions come up, write them down and leave space for the answer, because eventually when you get to another video that you watch by me or a live stream, I'll cover something. But obviously, there's so many of you that are watching. I know most of what you're going to ask me anyway, and most of those things are already answered in the old content that's on my YouTube channel. All the old lectures, they're not stale. They don't stop working because they're years old. All the stuff that I taught in 1996 they're still happening right now. And you're talking about the algo changing. Come on now. So 15-minute time frame, Caleb, is what you want to focus on. Early on, I expect Caleb to have the wrong buy side and sell side annotated. It's normal for that to happen. I want him to mess it up so that way I can show him what he's doing wrong and where the right one is. That way, if you're doing similar things, you will have that experience of, oh yeah, I probably was thinking the same thing, if you're even doing it at all. That's why it's important before you watch anything that appears on Caleb's channel, you do it first in your own charts, okay? Because that way it's like the same experience. By me showing you mine, I'll show you what my charts look like at the end of the day. This is my annotations. This is how you should have your charts marked up. These are the observations that you should have, in my opinion, based on what I believe you as the audience member, specifically Caleb, my son, you should be focusing on right now. It does not mean it encapsulates every possible thing that I've ever taught on. It just means that as a beginning basis point, like if you're brand new and you want to know how to start, this is how you start. the 2024 mentorship, and then watch what I'm doing over my son's channel. For the next couple of weeks, it'll be primarily me talking. And then because he's seen enough examples of it, he can ask me pertinent questions that are useful. Otherwise, right now, if I sit with him and he says, all right, Dad, what about this and what about that? They're infantile questions, and they're best suited to be answered just by going through the process of me watching, the next couple of weeks, reviewing, doing the screenshots for his journal. And then he's going to try to, in his best effort, try to replicate that on his own. And it probably won't be as clean and crisp and it's going to get on my nerves because I'm OCD. But you are looking at those charts. What they are documenting are important to you. I'm watching this over here. So I'm looking at this little section of price action. See how we went down, up, and then now down. So there's this inefficiency right here. This is the only thing that I'm watching. If it really starts to make a move above that, then we'll probably be working towards a deeper retracement post 930. But right now, it traded right back up in that little area here. I don't think that is a reason to stop price going higher, but that's just something I'm watching as I was talking to you. So 15-minute time frame, there's your liquidity pools, and then you strip it down from the 15-minute time frame down into a 5-minute. And levels that would be defined on this time frame, they're considered minor buy side and sell side. Okay, so you have primary buy side and sell side on a 15-minute time frame, and that's going to give you your first parameters for framing out or fleshing out a narrative for the session and or the daily range. So one of the things I like watching in other live streamers and other YouTube channels that are very upfront, and they tell you what they believe, what they think, their opinions, and some of them are actually executing on them. I'm thankful that they're willing to do that because they create pools of liquidity in sentiment. And it allows them, when they get on their YouTube channel, and this is not a knock against any individual YouTuber, I'm focusing on their audience because that's what I'm watching. All they're doing is creating another watering hole. So when I'm watching other YouTubers, it's a watering hole. Animals are going to go out to that watering hole and they're going to try to get a drink. And they're either chasing what this person's doing in the YouTube stream, which there's nobody out there I want to follow. Not one, okay? But I like watching my students, but I like watching specifically a number of YouTubers that have a decent following, and their animation around a particular bias for the day. If they think a certain level is going to be hit, and for instance, let's roll back in time. Let's just say right before 8:30, say it wasn't non-farm payroll, and we weren't going to have this fast run in price. The way I just framed out the sell side and the buy side, real time in front of you, I would have those same levels annotated the same way. It just means that it's likely to take a little bit longer to get to them because it's not a non-farm payroll, FOMC, CPI, or PPI type event driving price right to it. So because that resource that we have in YouTube, and it allows the folks to have a chat window and whatever, by watching the sentiment shifting, and if I see another YouTube channel that I watch and I think that they have a very busy channel with chat, I love that. And I'm not engaging in their chat, but sometimes I'll throw a bone out there to try to get some kind of, like if it's real dry and nobody's really chatting up anything that gives me kind of sentiment reading, I'll make myself known in the chat. And then all of a sudden, Billy Big Ass, balls or whatever you want to call it, guy wants to show everybody he's smart. He'll say something. And then that's what I'm looking for. I want the Joker to raise his head up. Because as soon as he does that, somebody else is either going to say, no, I don't think that's going to happen. And then a wave of other people saying, yeah, you're right, that's not right. Or they'll support him. That's me manipulating that chat room. Okay, I'm creating some fluctuation because I have to create a disturbance. I'm acting like a Judas. So I want their opinion. If I see predominantly most of the people that I'm watching, sentiment-wise, if they're saying they think it's going to go down, And I'm already seeing things like this low went lower than that one, and this one is relatively equal. See, this high here didn't go above that high, even though these could be framed, if you're looking at it that way, that would be a relative equal high. But this is high probability. Why? Because this high is lower than that one. Go back to what I was teaching you in the 2024 content so far. So this high over here is lower than that one. But you don't have that here, do you? You have this lower, and then you got this one over here, where it's just like, it's already disturbed it. It's disturbed that liquidity. Where here, it's a little bit more blocky looking, where this is a wick. If this wick gets overtaken, like it does here, that means it took a real run on liquidity, versus like how I treat a wick. I'll break that down into quadrants, and more specifically the halfway point. If I see a wick like this and we're above it, I want to see it trade down into the upper half of it, but not even go below the midpoint of it. But in this leg lower, it passed through that easily and spent time down there. What was it doing? It was accumulating. See, you don't have those signatures up here. It's more blocky. So that makes this a better candidate for a high impact or a medium impact news driver, drawing to that. But if it's not if it's not a high impact news event, like the PPI number that comes out, the CPI number, if an FOMC rate announcement comes out in the afternoon, 2:30 in the conference call, and then you have like a non-farm payroll event here, excluding them, everything else, if it's on economic calendar with a medium impact, I would expect that same type of thing unfolding here. It just would be a gradual trading up to that level for the buy side. Does that make sense? I know you can't answer me, but it's affording me the moment where I framed where the liquidity is, and then I'm actually getting a dynamic sentiment reading by people that have a vested interest in looking right on social media. Think about that. If they're going into these chat rooms and they're trying to voice their opinion, it doesn't matter if they're right or wrong. Okay, that's not my point. The point is they're willing to toss it out there in the ether. And I want to see how much traction it gains by anyone else in that chat room. That's how I'm using other YouTubers' streams. And if they start cheerleading the idea, oh, yeah, I like that idea, but my target's a little bit past that. That's exactly what I want to hear. I want to hear that stuff like this. Yeah, I want to see it go below that low here. I want to aim for 18,680. And then somebody else will come behind and say, no, I'm looking for 660, bro. That's exactly what I'm looking for, because now I'm arm wrestling them as smart money against dumb money, street money, okay? I'm not saying everybody in everybody else's live stream is dumb money. I'm just the ones that are acting that way when I'm expecting this low not to be taken and this area here to be drawn to. What you have at that very moment is the purest form of sentiment at a very specific time where it's diametrically opposed to what the algorithm's going to do. Who do you think is going to win that? Who do you think is going to win that, right? Come on now, you know the answer. Dumb money is going to fall on the sword of smart money, okay? And when we can see these tug of wars, these wars, if you will, between someone that's not informed, that are just impulsively trying to share an opinion for the purpose of looking right. Smart money is not trying to be right. Smart money is out there decapitating other large entities. That's what they're doing. That's what they do. The algorithm just delivers price. Smart money engages with that algorithm with their own high-frequency trading algorithms or discretionary trading, but they use the logic that I'm showing you here. So banks do not trade with what I'm showing you here. There's an entity outside of that, okay? It's outside of that. They're not Goldman Sachs, because Goldman Sachs tells you you can't trade in time to market. Well, they're really stuck with what I just did today. 2, I'm doing it every single day, proving where the market's going to go next. And does it look like noise to you? Does it feel like you're confused as to, oh, it's too much noise going on in these time frames? No, it's clarity, right? And it's encouraging. It encourages you to be able to say, hey, if this guy can do it, and he used to deliver pizza, Come on, man. I can do this if I apply myself. You just got to give yourself some more time and effort. So if the 15-minute time frame buy side and sell side liquidity pools are defined, it gives you an initial context. And I will counsel you, and the live streamers will appreciate you by watching their streams too, because they'll get more views. But every big name YouTuber that follows the futures market, my advice is quietly, respectfully, in anonymity, start watching their chat windows. Because I'm using that as the best sentiment indicator, because I know what I'm looking for technically. I'm looking for something to take place, to draw to a specific price level, to behave a certain way. And I have made that known to you since we started doing this mentorship. I told you every step of the way what I'm looking for. I'm using higher time frame charts to tell you what I think narrative-wise, but intraday, I can trade both sides. It's not a problem to do that. But if we're looking for that low on August 13th on the fair value gap, which I'll take you up to the chart in a second, that was where I wanted to see it trade down to this week. Once it hits that, I'm done. I'm not personally looking for anything lower. Can it go lower? Absolutely can, but I'm not going to be on that. Why? Because I'm sailing into the weekend. I'm done. I'm letting everybody else out here fight on non-farm payroll Friday to find something to make money on. When I just destroyed it, Godzilla's the atomic breath, boom, gone, nuclear waste now. And everybody else is trying to find scraps to eat. I'm out the door, I'm outie. I've already done enough damage. I don't need to do anything else. So I'm walking back out to the ocean and find myself in my Godzilla lair, right? So I know it's always some kind of movie analogy. That's how my brain works, man. So when we drop down from a 15-minute time frame to a 5-minute chart, then you start seeing smaller pools of liquidity. And what would that look like? Well, inside of this low and this high, that's your range. So if we think by dividing up the characteristics that the buy side liquidity pool has in contrast to with the sell side, the fact that this wick was overtaken, that to me is more indicative of this was a real stop hunt versus this blockiness. Okay, it's just real smooth compared to this. Would you agree? This is a little bit more jagged, more piercing versus all of this blockiness. So this is more likely to be drawn to on the basis of just the way the price printed it. Then you add to it, what day of the week is it? It's Friday. What direction primarily has this week been doing? Has it been going up all week? Or has it been going down all week? Clearly, it's been going down all week. We had a big old Tuesday drop down, okay, the first part of the morning. I wasn't part of that, but I smashed it in the afternoon. And then you watch what I did yesterday into today. So I don't need to be in there every day. I know how to catch up. I know how to fill in the gaps of days where I wasn't participating in, because I will let the market tell me what it wants to do. I want the setups to come to me, as I'll indicate when we break down that trade. But you have to look at price and discern when you're going to engage, when you're not going to engage. And once you have that 15-minute time frame defined, this is your dealing range. This is your high, and this is your low. What is the daily range, and or specifically, what's the morning session going to do with that range? Is it going to stay inside of it? Or is it going to trade just outside the low of it? Or is it going to trade just outside the high of it? Is it going to run both sides first? And if it's going to run both sides, which side does it run first? In this case, it ran to the buy side. But it stacks the odds against this being a prolonged move lower for me personally, because it's Friday. It's fulfilled my high time frame daily objective by going into that August 13th daily low fair value gap low. And that sounds like a whole lot of mumbo jumbo, but when we go back to the daily chart, you're going to see exactly what I'm talking about. And it's going to make perfect sense. But this isn't going to be a long video. It's just going to be easy for you to watch a few times to get the notes from it. After the 15-minute time frame is defined, where you have both buy side and sell side, dropping down to a 5-minute chart, then you can start looking at things like this, where this is a high, slightly lower high. So these are relatively equal. You might not see it that way. That's what I'm teaching my son to view it as. So buy side is defined with this high here. What kind of high would that be? What kind of buy side specifically would that be? A minor buy side liquidity pool. So you'd annotate it like this. I already have presets, and I know it drives you nuts. You save so much time. I'm teaching. I'm not trying to save time. I'm teaching. You want your brain surgeon to go through the Cliff Notes, and then you're going to be doing brain surgery on you? No thanks, buddy. I'm not doing that. I want the person that went through all of it the right way. So this way it helps teach how people are to annotate, because there's always new students coming in. Top, left, and I like 14 or 16, depending on what the chart looks like. That's good for you. So this is a minor buy-side liquidity pool, okay? And then we have, again, right in here, see these? So that same thing. So you can highlight, not the edge of it, highlight the line, hold down Control, drag your mouse away from it, and it'll copy it. And then you just put it on the higher of the two highs and extend that over. Okay, so you have a primary sell-side liquidity pool, a primary buy-side liquidity pool. What makes it primary? It's a 15-minute time frame dealing range. So that way it tells you what you are going to frame your session and or daily range around initially, because you have to have a starting point, right? Where do I start ICT? Where do I start looking? This is what you start with, okay? But that 5-minute chart will break down that range from this high down to that low into smaller buy-side and sell-side liquidity pools. So what are we seeing here inside this range? Primarily, it's buy-side, okay? We have a lower run here below a wick, so that means this is a little bit more jagged. It's Friday. It's been going down all week. So which side is non-farm payroll most likely? Not all the time. Not a panacea. Not a be-all, end-all. It's always going to work this way because ICT said so. This is my protocol. This is what I teach my students to look at price like this, to anticipate where the market is likely to go. I do the same thing with PPI and CPI. And I sometimes, and I'm talking about maybe 2% of the time, get it right. But 98% of the time, I'm wrong on CPI and PPI numbers, initial delivery like this. So I'm trying to remind you, don't think that you're going to walk out there like John Wayne and be like, it's over. You know, the Duke's here and I own all this stuff now. It's my show. There's a new sheriff in town. You ain't going to be able to pull that off. Okay, it's not going to happen, because if it could be done, I'd be doing it. And I'm not able to do it because no one knows what they're going to do with that information. That information may be technically viewed historically as a positive, but they sink it aggressively lower. And then they'll make the excuse later on, well, you know, they priced in, you should have known better. They didn't have any articles saying that they were expecting that, but there's always some excuse in the news feeds that it was priced in, traders priced in this, and come on. If it ain't something you're gonna tell me in advance, don't talk about it. Don't talk about it, okay? So I don't care about what the raw data is. I don't care what the job number is. I don't care how many jobs are lost or created. I don't care about that stuff, okay? Because they're all lies anyway. Everything about those data points, every single one of them are all fake. They're all meant to stimulate the pockets of investors and large institutions. That's what they're there for, okay? So it's like an illusion. It's a reason for you to have some other excuse to get in here and risk more of your money. That's what it is. So because I think about it like that, I don't go in with trying to decipher the fundamental aspects of it, because fundamentals have left the chat a long, long time ago. A long time ago. As soon as we left the 90s, fundamental analysis is now a joke, because there's so much lies built into it. You can't trust it. So it goes right back to where I started as a technical trader. The chart's going to tell you everything. Everything. So if we start looking at that range and we see there's a buy side here, there's a buy side here in a 5-minute chart, we can see how these are treated in the realm of how far we're going to reach back to that buy side, because we already determined that that's more likely, and you heard me say that before the non-farm payroll number releases. How we traded that first minor buy side, that's going to give you a clue, okay? It trades up to it here, and then watch what it does. Jams down. What's that doing? Taking out that short-term low, but it is not going below that low here. So as soon as this candle closes there, this one here is the next one that is considered. It trades above it, right back down in, and then rips through the buy side. You cannot trade this on non-farm payroll release. You can't. You're not going to get filled, or you're going to get slipped so bad. What is slippage? Slippage is you trying to buy it at, say, 18,845, and you get filled at 18,862 or higher. But you want to have a stop loss somewhere down here. You now just were filled at a very unfavorable place. And now your risk is incurred in a much larger capacity than you initially wanted to take on. If you